A $2 billion acquisition, signed, paid, integrated, then a regulatory directive lands, the whole thing comes apart. Meta bought Manus, a Chinese AI agent company. Over $2 billion. Zuckerberg personally oversaw the deal. The founders took roles inside Meta. About 100 engineers moved to labs in Singapore. The code was already being rewritten into their stack. The 27th of April 2026. A formal directive. Block the acquisition. Unwind the deal. Unwinding a deal sounds clean in a legal document. In reality, you're reversing months of integration, extracting code already absorbed, untangling people who've relocated, returning money already spent. The founders had to raise roughly $1 billion to buy their own company back, a hollowed-out version, tangled with Meta's systems, momentum gone, competitors circling the gap. This isn't a story about one deal going wrong. This is about what happens to the price of every Chinese AI company when the most competitive exit path gets blocked by law. I started with the ending, let me back up. Manus launched in March 2025, not a chatbot. A general-purpose AI agent. You give it a task, it breaks it down, calls tools, runs code, delivers a finished result. About 8 months after launch, roughly $100 million in annual recurring revenue, fastest any AI startup had ever reached that number. The product worked. The acquirer came fast. Meta. First conversation to sign deal. About 10 days. Price, over $2 billion. Meta's third largest acquisition ever. Before the deal, Manus moved its headquarters from mainland China to Singapore, closed domestic offices, blocked Chinese IP addresses on their website. The logic: if the company is incorporated in Singapore, a buyer acquires a Singapore company under Singapore law, clean jurisdiction, clean deal. That was wrong. The review mechanisms explicitly cover indirect acquisitions of domestic assets, regardless of where the transaction is structured. The technology was developed by Chinese nationals on Chinese soil. In AI, the technology isn't just in the code, it's in the engineers' heads. Moving a shell company doesn't change that. January 2026, compliance review opened. Founders faced travel restrictions. March. Formal investigation. April 27. Formal directive to block and unwind. First time the security review mechanism was used to dismantle a completed cross-border AI acquisition. The planned path forward, rebuild as a Chinese joint venture, aim for a Hong Kong IPO, scrub foreign stakes, majority Chinese owned. One case made it possible, what came next made it permanent. The 1st of June 2026, new outbound investment regulations, administrative law, not policy guidance. Effective July 1st, 3 changes that lock in the exit discount. First, codified unwinding power, a single legal basis to review, block, and force the unwinding of completed cross-border deals. Regulators can order investors to dispose of shares, cease investment activities, impose fines, ban outbound investment for 1 to 3 years. Any lawyer advising on a cross-border deal involving Chinese origin technology now has to factor in a real enforceable unwind clause. You can't structure around this by choosing a different jurisdiction. The law covers the origin of the technology, not the location of the deal. Second, Singapore washing is dead. The new rules prohibit transferring restricted technology through cross-border movement of personnel. The language is precise. It doesn't say you can't sell a company. It says you can't use the movement of people to circumvent the export controls. The people who built the technology are part of the technology. They can't be moved out of jurisdiction without permission. Third, countermeasure clause. If a foreign government imposes discriminatory restrictions on Chinese investment, retaliatory measures are authorized. This further narrows the already shrinking space where cross-border AI deals can close. The exit door isn't temporarily stuck. It's narrower by law, codified, enforceable. Chinese AI companies can still list in Hong Kong or on the mainland. What got narrowed is cross-border M&A, the exit path where most investors actually get out. Faster, more flexible, less disclosure, fewer gates. Cross-border M&A adds the deepest pocketed buyer pool to that flexibility. When that path narrows, those buyers are excluded. Fewer bidders, lower ceilings. It's arithmetic. Shrink the buyer pool, and the price adjusts downward. The exit constraints show up in the valuation numbers. 16 to 18x. That's the gap. Anthropic at $965 billion, DeepSeek at $52 to $59 billion. Two companies on the same technology frontier. One is worth roughly 17 times the other. By many benchmark measures, DeepSeek's models perform competitively with Claude and GPT-4. The capability gap is narrower than the valuation gap suggests. This isn't a company with a technology problem. It has a pricing problem, and the pricing problem is the exit. What explains 16 to 18x? Not performance, exit chances. Anthropic can go public. Investors have a clear, legally protected path to liquidity. The S1 filing turns speculation into a timeline. DeepSeek's investors don't know what their exit looks like. No confirmed IPO plans. The cross-border M&A path is narrowed by law. Exit path, uncertain. Think of it this way. Two bonds, identical coupons. One has a known maturity date. The other has an uncertain one. Might mature in 3 years, or 7, or not at all. The one with uncertain maturity trades at a discount. Same cash flows, different price. That's what's happening here. The cash flows are technology capability. The maturity date is the exit. There's a telling detail in DeepSeek's round. Founder Liang Wenfeng committed 200 yuan billion of his own capital, roughly 40% of the total raise. The round is dominated by Chinese strategic and domestic capital, not global financial investors. When the founder has to put up 40% himself, it says the global investor base either can't or won't participate at these terms. The capital structure is a mirror of the regulatory constraint. Strategic assets price like controlled infrastructure. The capability is frontier. The pricing isn't. And the pricing won't change until the exit infrastructure does. Then there's the domestic IPO path. Zhipu AI went public in Hong Kong in January 2026. Revenue, about 724 yuan million. Net loss, approximately 3.2 yuan billion. Minimax listed around the same time. Revenue, roughly $75, 80 million. Net loss, approximately 1.73 yuan billion. Real companies, real technology. But the revenue to valuation ratios live in a different universe from Anthropic, not because the technology is weaker, because the pool of capital pricing these assets is smaller, and the exit paths are narrower. A Hong Kong IPO gives you liquidity, but the buyer pool is predominantly Asian institutional capital and mainland money through Stock Connect. You're not getting the same breadth of global capital competing for the asset, the European institutional wealth funds, the American pension allocators, the Middle Eastern family offices that would participate in a NASDAQ listing. Without that competition, the price stays lower because the audience is different. Exit constraints, valuation ceiling, technology pricing. The constraint doesn't just limit your options at the end, it works backward through the whole chain, caps what investors are willing to pay now, caps how much capital the company can raise, limits what it can build, makes it less competitive over time, which further reduces what investors are willing to pay. A feedback loop. The technology gets priced not at what it's worth, at what the exit path permits. People look at the valuation gap and assume it reflects a view on the technology. It doesn't. It reflects a view on the exit, and that view is rational. From the buy side too, The most motivated acquirers in technology are companies with trillion-dollar market caps that would pay strategic premiums for the right fit. When those buyers can't participate, the competitive bidding that drives up acquisition prices doesn't happen. Think about what Meta was willing to pay for Manus, over $2 billion for roughly $100 million in ARR, a 20 times revenue multiple. You don't get that from a domestic strategic buyer. You get it from a global tech giant that can afford to overpay for technology that fills a strategic gap. When that buyer is removed from the equation, price discovery breaks down. The asset trades at whatever the remaining buyers are willing to pay. The Manus founders built great technology. They found a willing buyer at a premium price. None of it mattered. The technology worked. The cross-border exit didn't. And after the new regulations, that constraint is codified into law. Now, there's a pattern I keep seeing. Smart people look at DeepSeek or Zhipu or Minimax and say, the technology is as good as the global companies, the valuation is a fraction, so it must be undervalued. Maybe it is. But the next question has to be, undervalued relative to what exit? If the exit path never opens, the undervaluation is permanent. A stock trading below book value isn't a bargain if it can never be liquidated. The discount is real, but so is the constraint that creates it. You don't get to collect the discount just by identifying it. You have to be there when the constraint lifts. And nobody knows when that happens. The 16 to 18 times gap isn't a technology gap. It's the price the market charges for not knowing when you can get your money out. Industry advantage does not equal investment return. What determines the return is the exit path. Any market where the exit path is constrained by regulation, by currency controls, by structural constraints, you'll see the same pattern. The capability is real. The pricing doesn't reflect it. Not because the market is irrational, because the market is pricing exactly what it should. The probability of liquidity, given the rules. Being right but too early is the same as being wrong. I've seen too many people make the correct structural call, get the timing wrong, and run out of runway before the market caught up. The analysis was right. The bank account was empty. In China, structural constraints tend to stay longer than anyone predicts. The rules that create them change on their own timeline, not on a technology timeline. Those are two very different clocks. The technology might be ready. The exit rules might not be. That gap between technology readiness and regulatory readiness is where capital gets trapped. The most dangerous thing in Chinese AI investing isn't being wrong about the technology, it's being right about the technology and wrong about the exit. Technology risk you can diversify. Exit risk is correlated. The outbound regulations apply to all of them. The Manus precedent applies to all of them. The constraint is at the system level, not the company level. Before I put capital into any Chinese AI company, I ask myself, 1. What exit paths are legally available to me? Not theoretically, actually. Has a lawyer confirmed this path exists under current regulations? 2. Has a comparable company successfully exited through that path? Manus thought they had a path. It didn't survive contact with the regulator. 3. Is the discount I'm looking at reflecting technology risk or exit risk? One is a bet on the product, the other is a bet on the regulatory environment. They require completely different frameworks. If the discount is mostly exit risk, you're not investing in technology. You're investing in regulatory change. And regulatory change runs on its own clock. It doesn't speed up just because the technology is impressive. 4. What's my staying power? If I'm right about the undervaluation but wrong about the timeline, do I survive long enough for the exit path to open? The market doesn't pay you for being right in the abstract. It pays you for being right and solvent at the same time. Cash flow and staying power count. Because you need to be there when the constraint lifts.
If you take one thing from this episode, in Chinese AI, the exit path is the investment thesis. The exit path decides the return. Technology, team, market size come after. Everything else is secondary until you know how and through which path you can get your money out. The disconnect is a series. This is episode 1, the exit disconnect. If you found this valuable, subscribe and hit the bell. Which disconnect should we cover next? Drop it in the comments. This is China Alpha Hunter and see you next time.